Hey guys, it is Julie here with JT.Wealth. Today is part 6 of our dividend investing series, and today we are focusing on asset allocation and diversification. So let's get into it. All right, so welcome back everyone. Thank you so much for being here. As you may or may not know, this is our dividend investing series, where every single week we are putting $50 into an M1 finance account that is focused on dividend paying stocks. Now, the goal of this account in the long run is to be able to receive around $2,000 to $3,000 a month in dividend income. Our last part of this series, episode 5, we really broke down some of the calculations as to how we expect to be able to get that $3,000 a month. So if you haven't checked that out, make sure you give that a watch. As you also may know, we are not doing this investing challenge alone. So we are doing it with our good YouTube pals, Sam from My Financial Friend and Logan from Logan Fisher. Now, we are contributing $50 a week, but Sam is contributing a bit more at $100 per week, and Logan is doing $25. So no matter what your price point is for starting an investment account, there is a series for you. So in today's video, we are going to give you a quick update as to where our M1 portfolio is sitting at right now and the current rate of return. Then we're going to really focus on asset allocation and diversification. Before we get into all that good stuff though, this is just your quick reminder to please make sure that you are subscribed to the channel. Really helps us grow and allows you to stay up to date with all of our latest videos. And while you're at it, give us a big old thumbs up as well. So let's take a look at our M1 finance account. So full disclosure, I did miss the trading window this morning, so my $50 contribution is pending right now and will show in there after 8:30 tomorrow morning. I did mention in some of my previous videos that I won't be adding new stocks every single week, just because I'm looking to keep it simple and not too cluttered, really just focusing on about 10 solid stocks. So in the next coming weeks, I might add another stock or two, but this week that $50 is just gonna get distributed amongst our existing shares. All right, so let's get right into asset allocation. So we're gonna chat about what exactly it is and how it should change over your investing lifetime. So asset allocation is basically how your investment portfolio is spread out amongst different categories, such as stocks, bonds, or cash. This is definitely a personal preference and will come down not just to age, but your risk tolerance as well. Now, when we look at asset allocation, one main thing that we will look at is your ratio of equity to fixed income. Equities being your stocks, whether that's growth stocks, dividend stocks, any of those, and fixed income being your bonds, CDs, or treasury bills. So with equity, you have the exposure for more growth, but also potential for more risk. Whereas with fixed income, you have less potential for growth, but a more steady, predictable stream of income. Now, when it comes to investing, risk and reward go hand in hand, and this creates a scale of different investor profiles. So on the left side here, we have what we would call our more aggressive investor. So this is those higher risk investments that give you the potential for higher reward, especially over the long term. On the far right there, we have a lower risk, lower reward that's going to be a bit more predictable. In the middle, you have your moderate or balanced, as some people call it. So let's look at how this can relate to age. So as I just said, with the more aggressive, riskier stocks, you do have the potential for higher returns, but you do need to ride out more volatility and fluctuations. The longer you have to ride these fluctuations out, the more gains you can potentially see, which is why a more aggressive investment allocation is recommended for young investors with plenty of time until retirement when they'll actually need these funds. Now that's another big point. This is considering largely retirement or long-term investments. So if you're looking to save for your car or a house fund and you're gonna need that in the next year or two, this should dramatically change your investment approach as you don't have a long period to ride out any volatility. If your investment is suddenly down 25% next year when you are wanting to buy your home, you don't have the luxury of time to let it recover. Also, just because you are young does not automatically make you an aggressive investor. You do not want to have your money in an investment that's going to keep you up at night worrying about what's going to happen to it. So your risk tolerance will naturally grow over time as your knowledge of investing grows, but it's definitely a personal preference. So do not ever feel pressured to take on more risk than you are comfortable with. Now, as your time frame shortens, your asset allocation should adjust as well, slowly shifting the weight from mostly equities to a higher weighting in fixed income. This will start smoothing out that volatility. So you will sacrifice some potential return for a more predictable rate of return and less risk to your principal balance. This is especially key as you enter or near those retirement years and are going to need to rely on your investments for income year after year. So this is a great chart that kind of shows the relationship between expected potential returns and expected volatility. So we have that very conservative portfolio that you can see is mostly going to be your cash and fixed income, still a small portion of equities. But as you go upwards, your returns are going to be expected higher, but so is that volatility, with that aggressive growth being in your top far right, having basically no fixed income and all equity exposure. So let's look a little bit closer at each of these allocations, starting with the aggressive portfolio. So you can see here that you are essentially all in equities. It is also important to consider geography when you're looking at your asset allocations. So we're just inherently going to be overweighted in the countries that we are most familiar with. If you live in the US, you are probably overweighted in your allocation to US equities. Same if you live in Canada, the UK, wherever. This is just because that's what we're comfortable with. Those are the markets that we know, those are company names that we're familiar with, so it's bound to happen. But you're seriously limiting yourself and your growth potential if you're not looking outside your backyard at investment opportunities. So in an aggressive pie chart like this, you're going to see a nice mix of Canadian, US, and international equities. You'll have a lot of potential for growth. You're definitely going to see some up and downs throughout the years. Now, as we move to a more balanced or moderate portfolio, you can now see we have a much larger section of our pie as fixed income. So this is going to help start smoothing out the ups and downs that we would see in an aggressive growth one, as this portion of fixed income somewhat hedges against those volatile fluctuations of equities. Now, moving on to that conservative portfolio, you now have majority of your investments into fixed income. This is going to provide a much smoother, predictable, although slightly lower rate of return. You still are going to have a small portion of exposure to equities just so you can capture some of that market growth as well. Now, I discussed asset allocation in terms of geography, but within that allocation, there is another level of diversification that you need to consider, and that is sector. So this is an example of the sector allocation from a balanced fund. You can see that it ranges widely. On the equity side, we have financials, IT, industrials, healthcare, materials, all the way down to utilities and real estate. On the fixed income side too, we just have a nice split between the government and corporate bonds. Now, the reason that this asset diversification is so important is because different classes of assets perform very differently year over year, and it's impossible to predict which asset class is going to perform the best. So by having that broad diversification, you're really making sure that you're going to hedge some of your losses there, but also capture some of those great growths. So we can take a look at this asset class return quilt, which, yes, I know is a very overwhelming image, but it basically shows that year over year, asset classes can range greatly in how they perform. In 2006, you had real estate at the top with 35% returns, and then next year they were down at the very bottom at negative 17. So you can pick out those gray boxes kind of near the middle, connected with that dotted line. That shows you how a diversified portfolio helps you ride out these highs and lows for more predictable returns. Now, I know that this is a lot to consider when building your investment portfolio, but the main point I really want to make with all of this is just consider your financial portfolio as a whole. So if you have one investment account that you are solely playing around with some US stocks, maybe consider having that second portfolio with some international equity exposure to complement your US side. Now, a great way to achieve this can be through mutual funds or ETFs. There's lots of international equity funds out there, and it's a really easy way to expose yourself to a market that you maybe don't have the knowledge or just don't want to spend the time researching. Leave it in those professionals' hands who manage that fund for you. So that is my crash course in asset allocation and diversification. I would love to hear your thoughts on it, how you make sure that your portfolio is diversified, and what areas do you really focus on. So please make sure that you leave a comment and let me know your thoughts. I always love hearing from you guys. If you made it to the end here, you better make sure that you're subscribed and give us a big thumbs up. I hope you have an awesome day, and cheers.